hours, so there might be some hiccups, so please be patient with us. Again, Terry told you about me. Yeah, I grew up here, so fortunate. I'm a CPA. We have had a CPA business for over 30 years. We know taxes. We're independent financial advisors, so we know investments, financial strategies, so on. We're right down the street over there on the left in that nice, beautiful building. I was above the car wash for about 20 years, and that worked great. John Williams, fully licensed financial advisor. We're father, son, we're best friends, we're partners in the business, so it's really cool. So that's us. A little bit more, the other people in our firm outside our building. Yeah, I'm not going to go through everything. We don't want to make this about us, but I do want to thank Cassie, who joined us a couple months ago. She put together this presentation with Marie over here. So them two were, thank you. And thank you, Judy, for thinking of us to do this. It's an honor. I view our occupation as sacred, but to do in a group presentation, with everybody where you're at is very cool. So thank you. And the library is always great. Yeah. So the topics, we have a lot of stuff, and I hope I will read you guys summarize. Says I might skip over some of this. What we do offer with this, we could email you the PowerPoint. Any of you ever want to come in and talk to us for a little consultation, there'll be no fee for that on taxes or financial, whatever. But I'm just going to make a point of not trying to read it to you just that much. So we're going to cover Maverick. That's our sample client for financial planning. John Williams is going to introduce him, some of the issues he has and what he wants to accomplish through financial planning. Then I'm going to get the boring part of the thing. I'm going to talk about Tax Act, that now we're doing tax returns under this new act right now. We're going to talk some about tax planning, specifically AGI planning, adjusted gross income planning, and why that's so important. Talk a little bit about charitable planning, different ways to give charity that might be more tax efficient. Qualified business income, a brand new deduction. Any of you that have your own business or rental properties, this could be huge for you. It's a new 20% deduction. A little about estate planning, procurement planning, getting your ducks in a row. Long-term care, a little bit about that. Real estate, Judy wanted me to talk about that. One, if you sell your house, what are the rules? Reverse mortgage, kind of the pros and cons and the basics of that. The property tax, how you could transfer your property tax into a new home if you downsize. Social Security and Medicare, probably not much on that. We've done whole workshops on each one of those, and that's the most boring part, but I'm going to give you some basics, and just something maybe, hey, key something and you want to give us a call, what have you, do that. Then John Williams is going to take it over, talk about investments, how we look at investments, what a diversified portfolio is, factors you use when you build a portfolio, why is it important to try to beat inflation on a long-term investment. Very conscious that a lot of you already know a lot of this stuff, but I have no clue. So we're just going to put it out there. Then he's going to revisit Maverick after financial planning, after implementing some of the stuff that we talked about, just to kind of show you the difference. Because when we do financial planning, the biggest thing is, how long will your money last? How can we get your money to outlive you? So we'll kind of show one way to look at that when we quantitate these adjustments. So that's what we're going to try to do. And then, of course, here for questions. If we go too long, like I said, we have business cards somewhere. You get a clarity. If this and this happened, what lifestyle will your investments fund during retirement? And then you'll see the stress testing and see what different things do. So kind of give you the basics how your tax return works. And I know some of you know it, but this kind of frame it. First, we look at all your taxable income. That's wages, rental income, investments, Social Security, retirement, all that together. That's gross income. Then we have above line deductions. That could be moving expenses, IRAs, 401ks, HSAs. And that gets us to this adjusted gross income, AGI. That's real important with this new act because we want to reduce that more than we reduce taxable income. because adjusted gross income reduces taxable income, reduces tax, but it also reduces other things, like how much your Medicare costs you, or how much Affordable Care Act premiums you get. Is all based on AGI, so we'll talk more about that. So then we come to AGI, and now we take off either your standard deduction or your itemized deduction. This is Schedule A. Itemized deductions include medical over a certain amount of your AGI, so the lower the AGI, the more medical you get. Taxes, property taxes, income taxes, mortgage interest, charity, all those are put on Schedule A. We add those up, we compare it to the standard deduction. The IRS says, hey, we're going to give you so much deductions no matter what. If your state itemized or more, you get your itemized. And we'll go over that in a little bit. Then we have this new one, qualified business income deduction, which we'll have a little 2 minutes on later. Again, if you have rental property with a profit, or your partner, you're part of an S corp, or have a little business, that's a biggie. That gets us a taxable income. You figure our tax, you get some credits, some new ones for kids. Hopefully you don't have 17-year-old or younger kids right now, but if you do, there's some big credits there. And then of course we get to our net tax. The Tax and Jobs Act, over a year old now. Like I said, we're starting to do returns with this new weird act. To me, the individual part is a hodgepodge of stuff. They took away some stuff, they gave you some stuff, not real thought out. For corporations, they knew what they wanted to do. They wanted to reduce the tax rates for corporations, and they did. Individuals, it got real political, and it's kind of a mess. It's the biggest tax act since 1986, so 3 decades, 115 provisions. It affects everybody. It really does, one way or another. Hastily written, unclear. IRS is still working on details. We're still getting updates from the IRS. We're all going to have to go to another tax workshop to get the clarity. Big one, California has not conformed. That means your California return is going to be a whole lot different than your federal return. Just a pain. Term 5 years for individuals. You listen to Kamala, if I said that right. She might, if she gets president, she says she's going to reverse it right when she gets there. Who knows how long it will stay, but it's set to go 5 years. The corporates are permanent, at least set up to be permanent. Again, they reduced their tax rate quite a bit. So some of the areas that hit, above line deductions, moving expenses. Used to be if you moved for work-related stuff, you'd be able to write off most of your moving. Now you can't. You have to be part of the military. Alimony. Historically, you write off alimony off your taxes. If you're getting it, it's income. For agreements or divorce agreements starting in 2018, no longer deductible, no longer income. Big ones on the itemized. It's going to be harder to deduct your medical going forward. 2019 that starts, we're only to medical above 10% of your income. Adjusted gross income is deductible. Currently it's 7.5. Big one on taxes. On that Schedule A, you're able to deduct all your property tax, all your state tax that you pay to California or other states, some of your D&B tax, if you have a boat, your boat tax. So if you had property tax of $15,000, income tax of $5,000, that's $20,000, you'd be able to deduct the whole thing. Now it's limited to 10. So it's a big deduction. The people in California don't like it, New York don't like it, Washington, where they don't have a state tax, they like it. So again, mortgage interest a little bit there, where if you get a new mortgage for over $750,000, you're not able to write the interest off on that over $750,000. Home equity now has to be for home improvements or buying a home. It can't be used like borrow the money to pay off other debt or take a trip or buy a car. You can't write off that equity line interest anymore. Personal casualty, kind of a small one unless it affects you. In 2017, if your house burnt down and the insurance didn't pay for it all, you'd be able to write off the difference on Schedule A. Now you can't unless it's a federal disaster area. So again, Paradise, fine, but if you just, Moss Beach and one of those houses that burnt down, you might be in trouble there. Charitable stuff is pretty much the same, so we're going to spend a little time on that. Big one here, other itemized deductions. You used to be able to deduct tax preparation fees, investment fees, work-related expenses that weren't reimbursed, like union dues and all. Those are all gone. None of them. You can't write them off at all. So big one there. Miscellaneous other stuff. Yeah, I talked about QBI. Like I said, there's more credits for kids. 529 plans, a little more flexibility there. Now you could use some of it for high school or pre-college. Used to be just for college. And again, often there's no better gift a grandparent could give than 529 plan, because you're helping a grandkid and you're helping the parents take that off the plate. So they're still, they got better. I guess that's it. Big one, personal exemptions. 2017, you were able to deduct $4,050 for you, your spouse, and any dependents. 2018, there's none. They just took them away. So in 2017, if you're married with 2 kids that were dependents, you get a $16,000 deduction. Now it's 0. Now they helped make that up by increasing the standard deduction, which again, this is, no matter what, a married couple is going to be able to write now off $24,000, depending how much deductions. If they have only $5 of deductions, they're going to get a $24,000 deduction. 2017, it was half that much. So they really bumped that up. So a lot less people will be itemizing deductions because this is so big. For single, it's about half. It's 12,000. Used to be 6,300. Now, no 9,000, as you saw in the instructions. We were just going, yeah. So anyway, big difference there. Again, AGI, adjusted gross income. Why we want to reduce that is it not only reduces tax, but it reduces like Affordable Care Act premiums or penalties. That's based on that. There's additional tax, this additional Medicare tax when your AGI is too high. So if we could reduce AGI, we want to. Go ahead. Big one, it impacts how much your Social Security is taxable. The higher your AGI, the more your Social Security is taxable, or more of. It impacts the Medicare premium, and we see that quite a bit. If you have a big income year, and your AGI went up much, you'll see your Medicare premiums get bumped up, and you have to, be bumped up the whole year. So we'll look at that. Go ahead. How do you reduce AGI? If you're working, put money in your 401k, because then it's not part of total income, it's not taxable. You're paying yourself to get a tax deduction. Delaying bonuses. If you're part of a FSA or HSA, take advantage of it. Then stuff on investing, which we'll talk about in a little bit. Muni bonds. Again, California muni bonds are double tax-free, so it never goes into taxable income, so it reduces AGI. If you have some losses in your portfolios outside your retirement account, harvest those losses. We'll talk more about that. Maybe taking distributions from Roths if you have them instead of regular IRAs or 401ks. Qualified charitable, I'll go over that in a little bit. If you're self-employed, put money in retirement. If you're working part-time, you can put money in an IRA and deduct that and reduce your AGI. Maybe sell stock over 2 years versus 1 year, because that 1 year will bump it up way too high. We'll talk about this stuff later. So now we'll talk about one strategy on itemizing that wasn't around in 2017, but 2018 we're looking at it. It's called bunching deductions. So that's when you're close to that standard deduction. So let's say you're a married couple and your deductions are pretty close to it. So we're going to look at 2 years at a time now. Maybe it'll make sense to do a lot more charity in 1 year and none in the other year, because we're going to itemize that year instead of doing the same amount every year. So the best way I think is to show you an example, assuming I can explain it halfway decently. So this was an old strategy, and what we're showing is deductions. So if you just kind of pretend that is property tax, that you have $8,000 years of property tax, I know you can prepay and all that, we're just assuming that's a fixed amount. The charity is what we're going to play with. You normally give $7,000 of charity a year. So when we add that to your other deductions, your itemized deductions are $15,000. This is for a single person. Standard deduction is $12,000. So we deduct the 15. The second year you do the same thing, so we get another 15. Again, nothing fancy, we're just doing $7,000 a year. Your total deductions for 2 years is $30,000. New strategy, we still have this 8,000 that we can't do anything with. But for the charity in year 1, we're gonna say, hey, let's give nothing. But we're gonna give 14 in year 2, bunching it into 1 year, doing multiple year tax plan at the same time. So year 1, we only have $8,000 of itemized deductions. Standard deduction is 12, the amount the IRS gives you. So we're taking the 12. Year 2, we have 8,000 plus 14, so we have 22,000 of itemized deductions. We're gonna take that, so we add those two together, we get 34. So over that 2-year period, we had $4,000 more deductions, which probably saved $1,000 tax. So again, you could do that with property tax. Charity's one likely way to do it. Some investment stuff for tax planning. Like I said, muni bonds. If you're at a high enough bracket, you know, California muni bonds make sense for your non-retirement portfolio, for the bond part of the portfolio, which John will talk about. Long-term capital gains, they give a favorable tax rate if you hold on investments for over a year. That could be stock, you know, in your non-retirement accounts, that could be real estate, what have you. And to give you an example, married filing jointly, if your taxable income with all your other income deductions and your capital gains is $77,000 or less, you pay 0% on that long-term capital gain. So if you sold some Apple stock, made $1,000, and your total taxable income is less than that, you pay no tax on that Apple gain, that capital gain. If your income is between 15 and 479, you pay 15%, which is still lower than what your other income will be taxed. When you get big income, yeah, you pay 20%. Harvesting losses. With all this volatility in the market, might be a good time to sell some of your holdings that have a loss. Because if you bought some Apple stock and it went down $1,000, and you lost money, but you don't get to deduct it on your tax return until you actually sell it. So it might be selling that stock now, get that $1,000 that we could use for your 2019 return. Now in 30 days, you could buy that stock back without any kind of penalty. In the meantime, you could buy a similar stock with the same exposure. So it's a practice called harvesting losses, which could make sense. So if you do your own, you know, you might look at that. If you have a financial advisor, you just might say, hey, if I have any losses, does it make sense to harvest them? Roths, I don't know, many people have Roth IRAs? Yeah, a few, okay. They are great. When you have them, you love them. Because with a Roth, when you put money in it, you didn't get a tax deduction, but whatever grows up is permanently tax-free. So if you put $10,000 in a Roth IRA and now grew to 15, you never pay tax on the 5. Unlike the traditional IRA or 401k, when you put money in there, it was nice, you got a tax deduction. You put $10,000 in, it might have saved you $3,000 in tax. You don't pay tax when it grows, but when you take it out, you pay tax on everything. And so it's a tax deferral, not tax avoidant, I guess, not avoidance. Well, Roth is just permanently tax-free. So, all right. So, yeah. So what's getting more popular with the low tax brackets, because that's the other thing this Tax Act did, is reduce the tax brackets, is Roth conversions. So the IRS says if you have some money in a regular IRA, we'll let you move it to a Roth IRA. Now you'll pay tax on it, whatever bracket you're at, but now it'll be permanently tax-free. And it's not subject to required minimum distributions at 70.5. So we're looking at that, and now we go to this next one. And what we try to do with that is fill up these low brackets. So this is the actual new tax brackets for married filing jointly. And this is on taxable income after all your deductions, all your income. Your first $19,000 is taxed at 10%, which is pretty low. From 19 to 77 is taxed at 12%, which is pretty low. So the thought is, if we could get a Roth conversion taxed at these brackets, it might be worth paying that tax now to have it permanently tax-free growth in the future. And there's nothing I'd rather inherit than a Roth IRA, because they could discontinue it. So for example, if we added up all your income and deductions right now, and let's say you had $50,000 of taxable income right in here, I would say, well, consider converting $27,000 of your regular IRA to a Roth, because you only pay 12%. Now you pay California too. If I say paying that 12% might make sense, especially if you think tax rates will go up in the future, you know, or you don't want to be subject to required minimum distribution, or you just don't want to pay taxes in the future. Again, that Roth conversion might make sense to look at. We're looking at a lot more, again, because those brackets are so low. Okay, tax efficient distributions from IRAs. So this is kind of neat, and it has to fit for certain people. If you're over 70 and a half, you probably know you need to take money out of your IRA or 401k. The IRS wants to tax it, so they make you take out a certain amount. The IRS says, hey, if you want to have some of that go directly to a charity, we'll let you do it, and then it's no longer income. So in that example, if you had a $10,000 that you know you're going to give to your church anyway, you can have it right out of your IRA, your required minimum distribution. It's not income, and what it does, it reduces HDI, and it's not even on Schedule A for itemized deductions, so you still get your full standard deduction. So again, it could be something if it fits right. You're over 70 and a half, you have the required distribution. Say you're not itemizing because your standard deduction is enough. Hey, look to do this. You know, just talk to your IRA company, hey, I want to make a charitable distribution from my RMD. They'll send it right to them. It's not part of the income when you get to 1099 at the end of the year. So kind of cool. I think you can get about 100,000. Another one on giving money away. If you do give money and you have stock or securities or real estate or something that has a lot of gain, you might want to give the stock to the church versus giving the cash and selling the stock. So I'll give you an example. This couple has Apple stock, or no, individual has Apple stock. They bought it for $2,000. It's worth $10,000. So they made quite a bit of money. It's not in a retirement account, it's a separate stock. So they have gain of $8,000. The old strategy would be, okay, let me sell the securities and give my church the money. So in that scenario, they do have a $10,000 deduction. Let's assume it saves them 35% in taxes. So save them $3,500 to give that $10,000 away. But they have to pay capital gains on the $8,000. So they have to pay $1,200 or so in tax. So the net savings is $2,300. Now, if they were just to give that stock to the church, the IRS says, hey, you still get the $10,000 deduction, which means you save the $3,500, but you don't have to pay tax on the gain. And the church doesn't either, or the nonprofit, because they don't have to pay taxes. So they get the stock, they could sell it, no gain, nobody pays the $1,200, so the net savings is $3,500. So again, another way to really tax efficient charitable planning, again, in the right situation. Not going to spend a lot of time on these, but one I want to talk about, this little donor advised fund. That's kind of like having your own private foundation for charity. So you set it up at an investment place, or I think even Wells Fargo's type set up. And let's say I wanted to bunch my deductions, my charitable deductions in year one. I could put $15,000 in a donor advised fund. I'm the trustee of that fund. I get a deduction for that $15,000, but it doesn't have to go to the actual charities till later. So I could decide next year, hey, do I want to send some to here, some to here, some to here, or wait a couple years? I could add to that fund. So it's really an efficient way that doesn't cost a lot to set up to do that, to kind of bunch those deductions, or just allow you to make a deduction now and decide who it goes to later. My favorite example is a client of mine who inherited a lot of Exxon stock when she was a kid. It's worth a ton now, so there's a whole bunch of capital gains. One, she has a lot of charities she likes, like the Humane Society and this and that. And she doesn't like Exxon. She's more social responsible. But she knows if she sells it, she's gonna owe a lot of tax. She doesn't know how much money she wants to give. So she put $100,000 out of Exxon stock in a donor advised fund, got the $100,000 deduction. We'll decide who it goes to later. She might give it out in 10 years. And there's no tax to be owed. You know, because in the donor advised fund could sell it, because it's a nonprofit. It doesn't pay any capital gains. And what we did for her was really cool. We put it in a social responsible portfolio. So it was kind of a win-win-win for her. That balanced out some of the Exxon she didn't transfer. So kind of cool. There's other ones. I won't go there. I think I'm talking too much already.